Good day. This is the Home Profit Code. And today we're going to talk about a very, very important topic. We're not going to talk about business, but we're going to talk about your money. This is a very important topic. I'm reading a very, 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 very eye-opening book from my good friend, Robert Kiyosaki. You need to read this book. It's called Fake Money, Fake Teachers, Fake Assets. It's called How Lies Are Making the Poor and Middle Class Poorer. That's right, people. You need to read this book. It is eye-opening. And the link that I shared with you also is something that I'm going to talk about while I'm reading this book. This book here, I'll read about this right here. This excerpt you need to hear. Okay, you need to really listen to this. It's called "Who Took My Money? How Retirements, Pensions, and Fake Assets Are Causing the Poor and Middle Class to Grow Poor." Okay. Since 2008, the four biggest central banks have printed over $9 trillion to save the world economy. So where'd all the money go? Who got the money? Did you? And why are so many pensions going broke? Makes you think. Threats to the world economy. Today I write, in late 2018, there were four serious threats to the world economy. They are rising interest rates. After 2008, the central banks of the world lowered the interest rates to the lowest level in recent history. The central banks needed people to borrow money. Cheap debt blew the world into massive asset bubbles. Stocks, bonds, real estate, businesses became hot air balloons. Rising interest rates will bring these hot air balloons down. China is in trouble. China may have the worst debt to GDP ratio of all major countries. China borrowed and loaned out more money than any other country. If China crashes, the world crashes. Countries like Australia and Brazil that export raw materials to China suffer while China struggles. 3, a strong U.S. dollar. When President Trump lowered tax rates, especially for B quadrant businesses, the United States became a tax haven. Billions poured into the U.S. economy, causing the U.S. dollar to grow stronger. A strong dollar is not good for workers because U.S. products become more expensive and jobs are lost if demand for U.S. products drops. A strong U.S. dollar is not good for emerging countries that borrowed in the U.S. dollar. A strong U.S. dollar means their currency becomes weaker. This makes it harder for these small countries and companies to pay off their debt in U.S. dollars. 4, pensions. This is what you need to listen to. As stated in an early chapter, workers' pensions all over the world are going bust. In the United States, Social Security, Medicare are on life support. Just as millions of baby boomers are retired and need to rely on these social programs, here's a fact that you may be familiar with. Number one cause of bankruptcy in America is medical expense. In 2030, the year baby boomers became super seniors, 85 plus, the global pension systems may collapse just when baby boomers need the most money the most. This is some scary stuff, people. Repeating quotes on the growing pension crisis from previous chapters. IMF awards. The biggest source of risk comes from state and local government retirement pensions. Simon Black warns, Spain's pension funds is almost fully depleted. United Kingdom has trillions of pounds worth of unfunded public pensions. Even conservative Switzerland has a public pension that's only 69% funded, a seemingly fantastic number by today's dismal standards. Martin Armstrong warns the largest public pensions funds in the United States is California Public Employees Retirement System, CalPERS, for civil servants. California is in a state of very serious insolvency. We strongly advise our clients to get out before it's too late. Reuters warns the Pension Benefit Guaranty Corporation to become insolvent within a decade. The PBGC is the U.S. government agency that acts as the backstop to troubled pension plans by ensuring the pension of millions of American workers. If millions of workers contributed trillions of dollars into these pension funds, why are these funds going broke? Who got all the money? Makes you think. A better question might be, why are the rich getting richer? Okay, so this is a chart here. This is a gap chart, so you can see. See if you can see that gap chart. So you see how he breaks it down? The richer are getting rich, okay? And as we go into this book further, it's going to share you how they are getting through. And it's going to open your eyes up of how it's been going on for a while. And how the middle class is just, just cruising along. More debt, die with debt, debt. You can understand it. I'm understanding it now. A picture's worth 1,000 words. This chart shows the pension money went from poor and middle class to the rich. Wait a minute. Are you saying our pension money flowed from poor and middle class to the rich? I am. Without real financial education, the poor and middle class are lost in space. They have no idea how their money and wealth are being stolen by the rich via the money they work for, their taxes, their homes, their savings, and their retirement accounts. The cash heist. This is what I love about this book. He's going through the history of it, okay? And it's got true documented information in it. So, in 1983, I read Bucky Fuller's book, Grunch of Giants. Grunch, you may recall, stands for Gross Universal Cash Heist. In 1983, I became a student for the first time in my life, wanting to find out how the Grunch stole our wealth. I found out Grunch steals out wealth via our governments, our educational systems, our money, religions, banks, and Wall Street. The following are 5 ways Grunch steals our wealth via our money-saving investments. 5 reasons why the poor and middle class lose. Reason 1, gamblers run the casinos. During the 1950s and 60s, only gamblers invested in the stock market. It was considered unethical for financial advisors to recommend stocks to their clients. The fear of 1929 stock market crash and decades-long depression that followed remained fresh on the World War II generation's mind. During the 1950s and 60s, smart investors purchased government bonds or saved money. In 1950 to the 60s, my poor dad and my rich dad were savers. Saving money was safer than the stock market because after the 1944 Bretton Woods Agreement, the US dollar was backed by gold. See? Gold. The link that you have there, you need to click on it. It talks about, guess what? Gold. Just watch that 3-minute video and get back with me. I have a simple question for you. Have you heard of cash gold? That's the question I ask. And I'll provide you some more information later on. But I want to get this important information out to my viewers. You need to listen to this. So as I said, the 1944 Bretton Woods Agreement, the US dollar was backed by gold. The US dollar became the reserve currency of the world, or good as gold. In 1971, Richard Tricky Dick Nixon put the final nail in the coffin of the gold standard. The dollar and all government money became debt. Gamblers took over the government casino. Debtors became winners and savers became losers. The educational system of the world never mentioned this crucial turn of events in world history, did they? This is why you have to self-educate yourself, people. You need to understand that it's great to go to university and get an education, but they're going to teach you what they want you to be taught. You need to self-educate. There's books out there about this stuff. There's people. Robert Kiyosaki unconventionally does things, but his information is spot on, people. Spot on. The reason I got this book is I watched one of his videos and I'm like, wow, I'm blown away. I've only had this for a few weeks. I'm almost done with this book and I want to read it again. That's how good it is. Okay. It's power packed with information. And that's why has started investing in gold. That's right. With that link right there, there's more information. Also, information there. All right. The dollar and all government money became debt. Gamblers took over the government casinos, as I said before. Educational system. Poor dad continued to save. He did not change. He was counting on saving government pension to save him. Okay, like a lot of Americans and a lot of people globally. Rich dad did change. He had to change because an entrepreneur, he did not have a government paycheck or pension to fall back on. And that's the power of being an entrepreneur. Sometime in 1973, I'm a 1973 baby, Rich Dad changed his tune entirely. In 1973, after realizing what the government was up to, the Rich Dad came up with his lesson one, which is the rich do not work for money. Lesson one, the rich do not work for money. Think about that. In 1973, Rich Dad realized money was toxic, designed to steal the wealth of anyone who worked for money, saved money or invested money in the government-sponsored investments such as 401k, IRAs, stock, mutual funds, and EFTs. In 1973, Rich Dad advised his son and me to learn to use debt to acquire assets. This is why I took my first real estate course. I also took stocks and bonds courses, as well as my certified financial planner courses. As you can see by the chart, it says a U.S. Treasury bond interest rate history chart. It's been well up around until 1990. After 1990, interest rates began to decline. Poor and middle-class savers began to become losers. After 1990, the gamblers led by the Fed, big banks, and U.S. Treasury began printing more and more money to save themselves and their rich friends. Why savers are losers? As you can see, printing money made the working poor and middle class poorer because fake money creates inflation. Inflation makes life more expensive. You see, when you go to the grocery store, you're experiencing that pinch when you experience it because each time you go there, it seems like it's more and more expensive. You're getting less and less groceries when you go to the store. Inflation. All right. Repeating Rich Dad's lesson number one. The rich do not work for money. Repeating Poor Dad's lesson. Go to school, get a job, work for money, save money, and get out of debt. I did not listen to my poor dad. The brief history of the heist. After 1971, gamblers became winners. Notice the accelerated rise and illustrated on 125 history of the Dow Jones Industrial Average in the stock market after 1971. You can see that. In 1970, business schools started to badmouth gold, calling it, by John Maynard Keynes' phrase, a barbaric relic. Guess what? It's no relic, people. Gold is God's money. It comes from the ground. It's been doing better than the market. And guess what? It's going to be there when we return to be with our Lord and Savior. It's there. Whether you like it or not, you need to invest in gold and precious metals. I still invest in 401k traditionally and mutual funds. And yes, I've been doing that since I was 25. But that's what I knew because that's what I was self-educated about. Now I've added the fact that I'm buying small portions at very affordable prices of gold. Yes, gold. With that link right there. And other things too. All right. So today, most MBA graduates and corporate executives know only fake money and fake assets. You'll see how everything's connected now. They do not know much about God's money, gold, and silver. In 1970, poor middle-class kids were admitted to Ivy League schools for the rich. In his book, Tailspin, Steve Brill writes about how poor and middle-class kids like him were admitted to Ivy League schools and began rubbing shoulders with multi-generation rich kids whose parents owned businesses of real estate like the Kennedys, Bush family, and the Trump family. Poor middle-class students of our finest schools, such as Barack Obama, Bill and Hillary Clinton, realized they had no catch-up to their rich classmates. Notice all three are attorneys. As Brill, also attorney from Yale, writes, attorneys from the poor and middle-class backgrounds began inventing fake assets, financially engineering derivatives that made them richer, but ripped off poor and middle class. In 1972, President Tricky Dick Nixon opened the door to China. The working poor became poorer as wages stagnated or jobs were lost. So you see how he screwed over America? See how? Yeah, see. This is the start of the fall of a lot of stuff. Now, in 1974, IRSA, which is the Employee Retirement Income Security Act, was passed. IRSA was pushed through by lobbyists, big banks, the Fed, Wall Street, and thousands of other special interest groups, the military, teachers, unions, NGOs, the swamp, as President Trump calls them, that want government tax dollars. 4 years later, we saw the origin of the 401k, which most of us, if you work for somebody else, you have a 401k. The IRSA, 401k, and IRAs are products of the swamp. IRSA's paved the way for 401ks, IRAs, employee pension plans. IRSA's opened the doors to the big casino known as stock and bond markets to millions of poor and middle-class workers without any financial education. As leaders printed money, ripping off most workers, a few middle-class investors, such as my rich dad, caught on the heist and did well at stocks, bonds, and real estate markets were blown into bubbles. By 1978, millions of amateurs were forced into giant casinos of banks and Wall Street owned by the rich. Rich Dad called their giant casinos the House of Cards. This House of Cards became even more unstable in 1999, when the 1933 Glass-Steagall Act, which separated commercial and investment banking activities, was repealed. President Bill Clinton and his band of elite bandits, led by Treasury Secretary Robert Rubin, former co-chair of Goldman Sachs and chairman Emeritus of Council of Foreign Relations, put the nail in the coffin of the working poor and middle class. How did the Glass-Steagall Act put the nail in the coffin of the working poor and middle class? The Glass-Steagall allowed bankers to take mom and pop savings and invest their savings in the great casino. You see how things are reciprocated? When the casino lost mom and pop's money, the Fed and the U.S. Treasury bailed out the casino, saving the rich at the expense of mom and pop's future. The rich bet mom and pop's money. The rich lose mom and pop's money. Mom and pop pay for the loss of their money via taxes, and bailout money paid the bonuses of the rich who bet and lost mom and pop's money. Doesn't this sound like something that's already happened a long time ago? The House of Cards collapses. Even with all this abuse of mom and pop, things were okay. After all, who cares if only a few million people are stepped on? Then the House of Cards begins to wobble. In 1998, the foundations of the global paper casino began to crumble and the giant crashes began. After the 2008 crash, the global central banks and U.S. government printed an estimated $9 trillion to save themselves and their friends. As I write in 2018, the world is in another giant between 1971 and 2018. The poor, middle-class workers who worked hard to earn fake money, saved fake money, and invested in fake assets run by fake fund managers educated in our finest business schools became today's biggest losers. Three giant bubbles. Giant bubble number 1, 1998, Thailand. Bubble 3, top year, 2018. In 2018, as interest rates rose, stock and real estate markets fell. According to CNBC, super rich Asians lost over $100 billion in the first 6 months of 2018 in the Asian bear markets. It's been reported that between October 1st and the 14th of 2018, an estimated $6 trillion evaporated from the global capital markets. Is this the end near? Were the crashes of 2018 a sign that the rich have left the casinos? 10 years after 2008, are mom and pops about to lose again? Triple tops. When I was in high school, I spent most of the time surfing or gazing out of the classroom window watching for the ocean swells. Every surfer knows giant waves come and sets in. Generally sets of 3. That means when you miss the first 2 waves, turn and head out to sea. The giant third wave is coming. I vividly remember the biggest wave I've ever rode. It was the winter, the time when the giant waves hit the shores of Hawaii. I should not have been in the water. I should have been standing on the beach with the crowd gathering to watch the snow. Show, not the snow. The waves were bigger than my surfing ability. I kept me in the water. On this day, I heard a surfer much further out from me shout, "Outside!" That meant I was far inside, right in the break zone. Immediately, I turned my board and paddled frankly, hoping to get outside. The first of the waves was like a mountain. I barely got over the top, only to see the second heading towards the shore. As I cleared the top of the first wave, I saw the outside surfers still paddling. I knew the giant third was coming. I knew I had to catch the second wave or get wiped out by the third wave. I was a little late in my takeoff on the second wave. I estimated it was 12 to 15 foot swell. I probably crested to 18 feet as I stood and took the drop. My legs wanted to quit as I raced ahead of the wave crashing behind me, but somehow I kept my balance, rode as far as I could, got to the beach, picked up my board, and ran as fast as I could up the beach to get out of the way of the third wave that was just beginning to crash. The sight of fellow surfers going up the face of the giant third wave, not making it, watching the swell crest, then break, and seeing their boards flying through the air burned in my memory. When people ask me how I learned to time the markets, I simply say I grew up surfing. The chart below shows the biggest financial waves in history. Why the Rich Dad Company was formed. Notice the three peaks in the trader's talk. This chart pattern is known as the triple top. You talk about that, if you can see that. The first top was 1998. The second top was 2008. We will then see the third top. Historically, third peak signals a long-term exhaustion point. Often a plunge falls after a third peak. I suspect that between 2019 and 2025, many amateur gamblers who are rich today may become tomorrow's biggest losers. When will the giant crash occur? What are some of the foreshocks? Rising national debt and entitlements. Flash crashes in the bond market, stock markets, major environmental disasters that would cause insurance rates to rise, cyber hacking, global war and terrorism without end, government leaders who fight and call each other names rather than solve national and global problems, and Nero fiddled. And this old saying that goes, Nero fiddled while Rome burned. The chart below shows America burning while our leaders raise money for their next election campaign. The gap after inflation and taxes. See? As the golden age of gamblers coming to an end. As the saying goes, gambling is a sure way to get nothing for something. As Matthew 12:20-16 states, the last will be first and the first will be last. This book is dedicated to those who may be the last today and who want to be the first tomorrow. Reason number 2, inflation. Blessed are the young, for they shall inherit the national debt. Herbert Huber. If there are no government guaranteed student loans, college tuition will be much lower. Gary Johnson. Concern for the coming generations. Baby boomers in the United States had an easy life. We grew up during the biggest economic boom in world history. Their children and grandchildren, Generation X, the millennial generation born after 1982, and Generation Z, intergeneration born after 1995, have a very hard road ahead. Not only as many millennials unemployed or underemployed, but many start their adult lives burdened by onerous student loan debt. They also inherit a massive national debt, a financial disaster left behind by their parents, grandparents, and great-grandparents. History will haunt the future generations. If future generations do not change the corrupted system, what will their children and grandchildren inherit? By continuing a process of inflation, government can confiscate secretly and unobserved an important part of the wealth of their citizens. John Maynard Keynes, from 1883 to 1946. The way to crush the bourgeois middle class is to grind them between the milestone of taxation and inflation. This is Vladimir Lenin. Inflation destroys savings, impedes planning, and discourages investment. That means less productivity and lower standard of living. Kevin Brady, 1955. Why does the government want inflation? To pay the national debt with cheaper dollars? That's the answer. What happens if the government fails to create inflation? The opposite side of the same coin is deflation. If there's excessive deflation, the U.S. and world economies may slide into the next Great Depression, which will not be pretty. Are you saying the government wants us to work for an inflated dollar that are worth less and less? Yes. Purchasing power of the consumer dollar. This diagram shows you how the inflation in the United States has eroded the purchasing power of the dollar. We all know that, so I don't need to show you this chart. How does the government create inflation? There are many ways. One way is via printing money. Printing money makes money less valuable. As long as government banks are printing money, savers are losers. Debtors are winners. Remember, the banking system is based on printing money. It is known as fractional reserve system. That means for every dollar a saver saves, the bank is allowed to lend out a fraction of that money. If the fractional reserve is 10%, the bank may lend out $9 to the debtor for every $10 of the saver's money. When the $9 goes to the debtor's bank, the debtor may lend out $8.10. The sad truth is there's only $1 of real money in the savings. That is why if savers panic, the banks may not be able to give the savers back their money. Bail-ins. We have all heard of bailouts in the future. They may be bail-ins, which means the money you have in the bank is converted into bank stock. You become an investor in the bank. That is why it may be smart to get a fire-rated home safe and keep gold, silver, cash, and important documents out of the bank. With that link right there, my gold is actually stored. Fake safes. Some people have fake safes. If a person is robbed, the owner may show the robber their fake safe and let the robber have their own fake valuables, such as fake jewelry, fake Rolex watches. Their real safe is best out of home, in a storage locker, or behind a fake wall. Well, mine's not even here. Mine's actually on my site, and it's stored for me by my company. My gold is. Interesting, isn't it? Many people secretly hide money and wealth overseas, but to do it legally, it can be confiscated. There are attorneys who specialize in this type of legal offshore banking. If you do anything I write about, please do it legally. The definition of money. In part 1 of this book, I wrote about the criteria order for money to be money. Money is a store of value. After 1971, all the government money became toxic, could not be trusted to be the store of value. By definition, all government money is no longer money because it no longer holds value. 2, money is a unit of account. The US dollar is a globally accepted unit of account for now. 3, money is a medium of exchange. Again, the US dollar is globally accepted medium of exchange for now. For one reason, why the poor and middle class grow poor is because they trust government money such as the US dollar. Answer, yes, after 1971, all government money became toxic, stealing the wealth of those who work for money and save money. Reason 3, real assets make the rich richer. Amazon founder Jeff Bezos is a billionaire. Do you think he became a billionaire because he receives a billion-dollar paycheck? The median income of an Amazon employee is $28,446 in 2017. Jeff Bezos earns more than $28,466 in 12 seconds. Jeff Bezos' annual paycheck is only $1.7 million. Although Bezos' salary is $1.7 million a year, technically, below, there's a reason he's called the richest man in the world. His net worth is skyrocketing, mostly due to the fact that he owns about 80 million shares of Amazon stock. This same chart explains why Jeff Bezos is so rich. Every month, a portion of the billions of dollars from millions of workers' 401ks and retirement plans flow from their paychecks into the share of Amazon stock. Jeff gets richer, although his salary may stay the same. See, he's a smart man. Lesson, cash and flow are the 2 most important words in the world of money. Every month, retirement cash flows from mom and pops of the world into the pockets of Jeff Bezos of the world. Reason 4, crashes make the rich richer. When the market crashes, it always does, the poor and the middle class are wiped out. When the market crashes, the rich always simply borrow money, and I buy back workers' shares at bargain basement prices. Reason 5, the rubber chicken dinner. When I just started out researching my formula to the riches, I would go to the rubber chicken dinners. That reminded me of the political fundraisers. At these RCDs, potential clients would sit people like me, have an RCD, then listen to a presentation by a money management company or financial planner. At a number of these rubber chicken dinners, I nearly threw up the rubber chicken. I could not believe people could swallow the rubber chicken BS. How do the rich get richer if pension funds are going broke? The name of the game is assets under management. Even if mom and pop's investments are not making money, the rich make money via fees, more fees from assets under management. Forbes, May 27, 2013. The heavy toll of investment fees. The thoughts of giving up 40% per year in investment return to pay for portfolio management advice would cause most people to walk away. Yes, this is the price many people pay when they hire an investment advisor to manage their mutual funds portfolio investment, EFT portfolio. NerdWallet, May 11, 2016. How a 1% fee could cost millennials $590,000 in retirement savings. NerdWallet analysis. At these dinners, I listen to financial experts tell me how their magic formula will make them rich. At one of these chicken dinners. I broke out my calculator, read the glossy brochure fine print, and computed the total amount of fees I would pay if I started investing at age 35. The number was stunning. If I started investing just $750 a month into foreign, I would be paying over $2.5 million in fees and hidden fees if the account returned 8% per year. You could buy a lot of rubber chicken dinners for $2.5 million. I had my accountant verify the numbers and said, it was a good thing you walked away. What stirred me is the number of people who just did not walk away. Most were waiting in line to sign up for a personal financial analysis. Why were they waiting in line? Because most were not happy with the returns of their current financial advisor. This is a good one right here. I like this here. A hot shot for New York's new magic formula was not the magic, as best that I could ascertain. Expert magic formula was not much more than following the SP 500, something anyone with a fifth grade education could do. The same hot shot claimed his fee was only 1%. Yet, when I studied the fine print, the fees were much, much higher. This did not stop desperate people from throwing hundreds of thousands of dollars, possibly millions, at him. What were people desperate for? Most average seek return on investment, yield, or capital gains. They simply want their money to grow, not shrink. Fewer than 5% of fund managers beat the market, yet fund managers always win if they lose. There are kinds of fees. There's brokerage account fees. This can be an annual fee to maintain a brokerage account, and subscription for premium research to help with trading strategy or fees. Trade commissions charged when you buy or sell certain investments, such as stocks. Mutual fund transact charged by the broker to buy or sell. Expense ratio, an annual fee charged by the mutual fund to index funds to exchange and trade. Sales loads, a sales charge or commission on some mutual funds paid to the broker or salespeople sold. Management or advisory fee, typically a percentage or asset under management. 401k fee, administrative fee. So we're going to stop right there. So you see, I wanted to share this information with you because it's eye-opening. There is so much here. And I could go into this whole thing, and it is eye-opening what they're trying to, what we're being taught. And the key is that you look at it and you look at the information and you look at it and you're like, wow. Why wasn't I aware of this? It's because there's entrepreneurs that brought this information out. People like Robert Kiyosaki, who's not your traditional. He's against the grain. With that being said, this is the Home Profit Coach with this financial tip. You need to get that book. You need to read it, absorb it. Check out my link. We do, as I said, we have some great information on it. I'm going to also provide you with some more information later on. The 3-minute link, it's about gold. And as I wait for this stream to end, I want to thank you. You definitely need to check out fake money, fake teachers.